traditional finance is moving more on chain. And at the same time, ICOs and tokens are realizing they need to be a bit more like equity in most cases and is becoming more regulated. And so we see a future actually where IPOs and ICOs are the same, one and the same thing. And we're building for that future where we're the world's first on-chain underwriter.
I want to start with this question in particular.
Sure.
The lack of retail in crypto, is it because of the lack of opportunities, or is this more of a macro issue that's happening right now?
Hmm. Well, I mean, first of all, thanks for having me on. Good to catch up. It's been coming up on a year since we last caught up in East Denver. Already almost time for the next one. It's a good question because those are retail access and macro environment have been kind of trends of 2025, and to some extent, it's hard to answer that question because they're kind of co-mingled, I think. The macro, not just the macro economic structure, but kind of the macro market structure, right? Just overall the way token launches these days work of you drum up a bunch of interest and then you do a big airdrop and then you have these big exchange listings, and it just like, between all the exchange fees you're paying, between all the market makers are paying, between all the big airdrop, I think there was a report recently that was making the rounds on Twitter of how for the vast majority of projects, the TGE day is that's the all-time high effectively, right? It's like another way of just saying down only price action. So is it a lack of retail? Is it the market, macro conditions? I think it's kind of one and the same where the current conditions, for most assets, it is the logical choice to not participate, long term and to farm the airdrop, dump the airdrop, and move on to the next thing. And that's the logical way to maximize your risk adjusted returns. So show me the incentive, I'll show the outcome, as Charlie Munger famously said.
So do you believe that your product is strong enough to overcome the macro headwinds?
Yeah. Yeah, I mean, it comes down to a couple different things. But as I said, like, if for most tokens, just dumping a TGE is the logical response, then that's what most people are going to do. And so to have a different outcome, you would need to have basically assets that have a positive ROI on TGE day, right? Because investing is all about future returns. Investing is not about the past, right? Investing is at any given moment, if you wouldn't buy an asset right now, it doesn't belong in your portfolio, right? So at every given price, at any given moment, you should be, the best investors are thinking, am I long this? Am I bullish this in the future? And so if most tokens sell off post TGE day, they have a negative expected value and expected return, then it makes sense to sell. So how do we shift that? Well, one thing is more realistic, valuations, right? Launching at a fair valuation where there actually is some upside post TGE day. Another thing is higher quality assets, right? We've seen some pretty big high profile cases just in the last weeks alone of token holders getting obliterated because the team got acquired. So equity holders, equity investors were happy, the team was happy, the founders were happy, everyone who had shares, but token holders that ostensibly have a token that relates to this project got left out in the cold, right? And so better assets, and I think the way that's going to look is in the future there'll still be network or protocol tokens for truly actually autonomous decentralized L1 gas assets, actually autonomous DeFi protocol tokens like Curve or Liquidity. But then most tokens or most potential tokens will be more like tokenized equity, because you can't have this world of, there's equity holders over here, and then there's token holders over here. The rights, the protections, the economic interests are totally different, oftentimes strictly better for the equity holders, and then expect retail to just keep buying the tokens at these inflated valuations when they have no fundamentals, as we've seen in previous weeks. So I think these are some of the macro kind of structure things that are contributing to the symptoms we're seeing in today's market.
But the traditional model works with IPOs. Why is that not translating into crypto?
Well, I mean, if you had tokens that actually represented this is a legally protected right to cash flows, and if the company or the protocol gets acquired, you get a payout. But that's not what tokens are these days, right? Tokens are this promise from the team that like, oh yeah, like in the future there'll be some utility to it, or we'll pay discretionary buybacks with it. So it's not the same thing as equity. And so yes, a lot of things in IPOs work, and if tokens were tokenized equity, a lot of the same things would work. And so at Legion, we started this track by drawing a lot from the IPO world. And we literally call ourselves, the world's first ICO underwriter, because we underwrite these network and protocol tokens. But again, for most businesses, for a Web 2 business or a Web 2.5 business that wants to launch a token, I would argue that unless that token is in some way equity, is tokenized equity or tied to equity, or you get both, then it is probably in the long run net harmful to the space, because you're creating these bifurcated two sets. You have retail investors that own the token, and institutions and VCs that own equity, and they do have conflicting interests to split the proceeds and revenue of the business to two different audiences.
Yeah, to your point, I mean, if you own stocks, you are a shareholder, you own a portion of that company, but with a token, it's doesn't necessarily translate, right? So you mentioned the ICO. I want to ask you about that because I feel like everyone still to this day is talking about those ICO days and how
Mm.
it was so fun. What actually broke between the ICO era and today?
Yeah, I mean, I think back in those days, you had more of the projects launching were protocols, were networks, right? They weren't these like Web 2.5 companies. They were like basic primitives of Web 3 that were going to be they were either going to fail, lots of them failed, but they were going to do that, or they were going to be autonomous, right? Like these, DeFi protocols like Synthetics, right? Like Chainlink, right? You had these like core pieces of infrastructure that are touching everywhere that really you can't really acquire like an L1. And it doesn't make any sense. Like no one can go out and be like, oh, BlackRock can't be like, we're going to buy Ethereum tomorrow. And so for these types of assets, and I think there were more of them or a higher makeup of them of the high profile ICOs back in the day, ICO and a token remains the right instrument. You also just had a lot more capital focused on a lot fewer tokens, right? And so you just had like people raising, literally hundreds of millions of dollars each ICO, right? Which is just, there's a lot more tension, a lot more froth, a lot more capital. And so you could support, even though they were arguably still irrational, you could support these irrational valuations because there was enough liquidity and money, circling around. Nowadays, it's much more competitive for mind share, for attention, for capital, for exchange listings, for just about everything, right? And so what that means is that you either need to have a higher quality asset that has better fundamentals, or you need to have higher, speculation activity, so higher mind share, these sorts of things that maintains your token in the spotlight. No pun intended, of course. And yeah, without those two things, again, it is the rational behavior to dump these tokens because they're just not going to hold up in price performance terms compared to other assets. So, like I said, investing is forward looking, but it's also relative. You're always choosing between, do I keep my assets in this vehicle, or do I park them over here? Do I put them in stable coins and farm, which is relatively low risk to can be high yield? Do I put them in other assets? And so all these projects that are launching are not only competing with tokens that already exist, but I think most projects don't realize their real competition is the tokens that don't even exist yet, right? You're competing for all this capital that's going to be deployed farming the next airdrop. And yeah, so those are some of the core problems we're trying to solve.
Well, one of those things is you mentioned at Legion, you guys are underwriting some of these projects. And
Yeah.
so, how do you put a valuation on a chain, for instance? Because I know that's a big debate right now in the VC space. Some people are saying it's based on user base, based on adoption, based on attention. There's all these different metrics. And
Yeah.
big reason why this is a big topic is because nobody really knows exactly how to measure it. So, why do you feel like you guys have figured it out?
Well, that's fair. I mean, it's a great question because, of course, literally underwriting means in IPOs, for those people who don't know, like, if Morgan Stanley underwrites, Airbnb's IPO, they are actually buying the Airbnb shares and then reselling them to the market, right? Before the IPO happens. We are doing, in some cases, similar things to that, but in most cases, we're not buying, 100% of the supply being sold upfront. And so we play a similar role to what IPO underwriters play. We help line up conversations with the right exchanges. You negotiate terms with market makers, mapping out your buyers, your sellers, finding the right buyers, doing road shows, liquid fund demo days. But in most cases, we're not literally underwriting. With that being said, we're of course working with the project to try and find where is that FDV that is going to have a lot of interest from the public sale, but not leaving a bunch of capital on the table, still being, fair. And so we look at a lot of different metrics, social traction, product traction. I think you're 100% right that it is notoriously difficult to value L1s in particular. The reason I think of that is, and I personally view them as almost like their own ecosystems or their own. I think basically every L1 gas asset is a form of money, whether it's trying to be or not. It is at least an in-game currency that you spend in that ecosystem, right? And so it's very like macroeconomic type of modeling that's mostly driven by speculatory premiums and not by fundamentals. And so that's why people have such a struggle. You can't really fit a model to these things because the results are going to be wildly skewed and like not representative of any kind of like fundamental truths because there isn't, too much fundamental truth to valuing an L1. Valuing a DeFi protocol or a Web 2.5 business where there's cash flows and those cash flows can be paid as yield to token holders. And now you're getting into the realm of like discounted cash flows, right? And like relative yields, that's relatively simple to put, fair values to things. But also, of course, as we've seen, the market can trade away from fair values quite persistently. But when it comes to L1s, I feel like all bets are off. But I personally think of them as I don't really like that narrative of like selling block space or like, gas fees or revenue. I think that's largely bogus. And I think the last few years have showed that with like Ethereum, not like the price hasn't really done much, even though it's in theory wildly profitable if you consider selling block space, revenue. I think it's more about monetary supply. It is a currency. One of the reasons I would argue that Ethereum hasn't done much is it has adopted a monetary policy of balancing, of zero deflation, zero inflation on aggregate, ergo price stability. And so I think you've seen that relative to other assets. And so, some people consider that more of a bug than a feature. But if you're trying to be a money that's widely adopted, widely used, like that's actually is a feature. But of course, if you're speculating on ETH, it doesn't feel that way.
It seems like the Aves of the world, because there's more revenue that's being generated there, it feels like it's a little bit more of like a traditional model that you can
Yeah.
put value on. But
Yeah.
to your point, especially with chains, a lot of them are trying to get away from gas fees to make it easier for people to use it. And if
Yeah.
you're saying that gas fees equal revenue, it seems like counterintuitive that your goal is to decrease your revenue. So
Well, also
it seems
really,
like,
really quick. I mean, L1s are making revenue and have quote unquote expenses, inflation in their own denominated asset, right? It's like a central bank, whereas an Aave or a DeFi protocol is earning revenues in another asset that they don't control, right? So it's a bit
mm,
more. It is very much more business-like, whereas an L1 is much more monetary policy, central bank currency like.
yeah. Yeah, a lot of nuances there. Now, how does blockchain actually improve capital formation just beyond putting assets on chain?
Yeah, it's a great question. I think some of the low hanging fruit is if for anyone who's ever done an angel investment or been a founder and had to go through the slog of raising, just the fact that you don't need to wait a couple days for wires, you can see on chain who's made payments, transfers can go through immediately. I think there's a ton of just everything that has to do with payments infrastructure also applies to fundraising, especially when you're talking about crowdfunding, because raising from 3 angels is bad enough. Raising from 300 people, if like you have to chase people for funding and this bank account got frozen and this wire actually went to the wrong place or this one's hung up for 5 extra business days, nightmare, right? Just putting everything on chain, full transparency, full composability, quick settlement or instant settlement, all that is such a immediate savings to time and cost. I think also that's kind of the low hanging fruit. I think, as you mentioned, tokenizing securities themselves to increase composability, to increase liquidity is kind of the next tier. So investors, especially, you might own like these shares of a startup that has a book value, right? In a relatable example, maybe you own some shares of like SpaceX, right? which is what everyone wants to own these days, you should be able to borrow against those shares, right? You should be able to do things like that you can do in DeFi, like borrow against them. It's a valuable asset. It's actually a non very volatile asset, so it's actually a kind of ideal asset to borrow against. And look, if you never come back, if you never repay your loan, that goes to your lender, who's making a percentage fee, and then also getting to buy shares at a discounted price for people who kind of default. And so I think that's kind of the next step that we're starting to see, and tokenized equity kind of has to play out more fully for that to happen. And I think beyond that, you'll start to see really cool solutions where you have like cap tables themselves that are living on chain, and like transfer restrictions around shares. So it's not that there's this concept of equity and then a token that represents this entry somewhere in a centralized database where, Carta or a transfer agent, says like, okay, Matt owns 3 shares, Mikhail owns, 5 shares. The actual record is not in a centralized database. It's actually on chain. The token itself is the record of equity, the primary record of equity, the source of truth. And so I think that's a bit longer tail, but like that's the ultimate end state and goal. It's hard to imagine us not getting there. And then you have, all sorts of benefits to speed of settlement, to liquidity, to composability, reduced fees, cutting out middlemen, all sorts of stuff that just makes it easier to access these investments. Because public markets, IPOs, right, have been the wealth creation engine for the middle class for previous generations, right? IPOs are happening less and less. Companies are getting acquired earlier and earlier, going public later and later. There's more and more activity in private markets. And so unless we adopt some of these tools to bring greater access into the private markets, the middle class and wealth inequality is basically going to get worse, all else equal. And so that's what excites me about some of these tools like blockchain, is that we can counter some of those wealth inequality effects that other technologies like AI arguably contribute to.
I'm curious to know how you came across this problem in the first place. What is your background? What were you doing before you got into crypto?
Yeah. Yeah. So before I got into crypto, I mean, going way back, started my career in traditional finance. So, was at Bloomberg LP, which is, the got the financial data company, was there for a short time, and then spent a number of years, about 3 years, on the algorithmic trading desk at Bridgewater Associates, which is Ray Dalio's hedge fund. I'm the guy who wrote the principles. And so, they're a macro hedge fund. So really saw everything from a kind of a bird's eye lens of, inflation, deflation, commodity tradings, FX flows between countries. And so got to have an appreciation for just the macroeconomic type of modeling and kind of like ways of expressing kind of, systems, and seeing like if I push one thing over here, what happens over there. So that type of like system thinking I really attribute to my time at Bridgewater. And that increasingly, the algorithmic side of things increasingly interested me. And so left finance, spent a couple years as a machine learning engineer, data scientist for Web2 startups. And it was during that time that like the ICO craze kind of kicked off. And that's what drew me into crypto. Fast forward a couple years from that, I moved full time into crypto, and given my background of financial trading and modeling and simulation building, I pretty naturally fell into roles that was like token design, parameter optimization for DeFi protocols. Worked for a couple multi-billion dollar, FTV protocols like the Stacks Foundation, Status, one of the first ICOs in Ethereum. And through that process, just saw a bunch of tokens launch and saw a bunch of the problems being repeated over and over. Like, there's got to be a better way to do this. And that led me to Legion. Yeah.
And so once you started a Legion, like what's the overall mission that you're trying to accomplish?
Yeah, the mission we're really trying to accomplish is greater access for investors, right? So matching the best value, or the most value add investors, I should say, with the projects or with the investments that are best for them. And if we can do that, founders win because they're getting more value add investors. Investors win because they're getting matched with more relevant deals, and they're beating out bots and Sybils and mercenaries and people who arguably don't deserve as much allocation. And the overall markets win because you have more incentive aligned, longer term holders, communities, rather than just like short-term minded, farm and dump type of mindset. Obviously, as I mentioned at the start of this, conversation, there's a lot of market structure challenges to that. but that's the future we dream of contributing to.
But do you think VCs win? Because
Good
play
question.
devil's advocate here, many would say that Airbnbs of the world and all these amazing tech startups, they all started with getting heavily invested by the VCs. So can they win in this type of environment?
So it's a great question. I love you also brought up the Airbnb example. So the short answer is yes, but it depends on the quality of the VC, right? We've seen an explosion in the last couple of years of like everyone calling themselves a VC, right? And you have these like tier 4 VCs that all they do is throw in a check and negotiate you to have like no vesting and then dump the token immediately, right? They're not adding any value to anyone except themselves. And so the crappy VCs lose. The good quality, the tier 1 VCs, the tier 2 VCs still win because I think, and we see this, with the projects that we work with, solid retail investors and solid VC investors bring very differentiated benefits. I don't think you need only one or the other. You need both. And coming back to Airbnb, that's a great example. They raised from VCs, but who was responsible for really powering that network and getting them off the ground and getting overcoming the cold start problem was hosts that would open up their homes and use the network. And Airbnb actually, when they eventually IPO'd, incurred great legal expense and went through a bunch of rigmarole and time to give IPO allocation to hosts of the platform. And imagine if they could do that with tokens and do that much more easily, much more quickly. They would have bootstrapped out, and been able to grow that much faster. How many Airbnbs never got off the ground because they couldn't do something like that? It requires a bit of regulatory changes, it requires some cost effectiveness technology changes that blockchain for the first time enables. But that's a perfect example of like VCs and retail, in my mind, playing a synergistic role.
And for your platform that you're building, Legion, have you found some traction from the VCs as well as the retail investors?
Yeah, it's a great question. So we do have VCs that actually and institutional players that participate in sales on Legion, like in the same smart contract alongside retail, and I think that's sometimes getting debates about it, but I think that's the best model is that retail and VCs are not only getting the same terms and the same price, they're literally participating in the same round. And so on Legion, we do have VCs that are sending funds into the same smart contract that retail investors are. It's transparent, right? Everyone can see it on chain and they get the same terms, same vesting, right? So yes, yeah, we do have institutional players that use the
So,
fund.
but what is the incentive there? Because to your point, you mentioned that VCs are in it to make money.
Yep. As
So
as is everybody.
correct. Yeah. And so, that's why I don't want to only poo poo the VCs because,
Yeah.
I think there are different tiers, like to your point, and a lot of them, the tier ones can help not just monetarily, but also strategically because they have the right
Absolutely.
connection. So I
Yeah.
certainly agree with that. But if they are tier one and they're able to get away with more,
Mhm.
I'm just curious to understand, like, what is the incentive for them to participate with retail when technically the old model that we're trying to get away from is not completely dead, right? It
Yep.
still exists.
Yeah, it's a good question. So I think it's mainly in the context of later stage sales where teams are ICOing, right? And like this is the final chance to get aboard the train before, the token is live. And so it's mainly like the team is just saying like, sure, we could take a check from a VC, but like we're doing the ICO, that's your chance. We don't want to deal with closing another round and legal fees and all that stuff. Here's how you can get in alongside everybody else. I think it's mainly team driven. Yeah.
I see. And these teams are likely more higher quality than usual to where they have the ability to filter out who they choose to take investments from rather than, look, I just need
Exactly.
money right now because I'm trying to get this off the ground.
Exactly. Yeah. I mean, that's a big point is yeah, like teams that kind of desperately need cash or need the ICO to survive, that is a very bad signal. So we like to, it's part of our selection process. It's part of the selection process for a number of exchanges as well for their listing decisions, right? Is how can the project survive even if we didn't do this? What are they using the funds for? And so the best teams are using, an ICO as a go-to-market exercise, right? As a mindshare exercise, as getting people aware. I like to say that um, airdrops are attractive to people who want to sell your token. ICOs are attractive to people who want to buy your token, right? And it sends very different signals to the market. And so, yeah, we generally see, higher quality projects that have done some VC raising in the past that are the best candidates for an ICO.
I usually call them prize pigs. I used to work in radio back in my day before I got into
Okay.
crypto, and we would have people that would literally drive around town just to come to your booth and get that free t-shirt, get that free pin. They were just there for the free stuff,
Man,
right?
yeah,
And
yeah, yeah.
so I think that there's a lot of correlation from the traditional world. It's the same thing, same mindset
Yeah.
in crypto with these airdrops. These builders, what kind of requirements do you have for them outside of what a traditional investor, or I should say a traditional VC might have for a project?
Also a great question. I mean, I should say most of that criteria overlap or are similar to what a VC would look for. You know, the social traction, product traction, team. You know, it's a founder that is stubborn about the big picture, knows what they want to build, but also kind of flexible and coachable on the details. So when it comes to criteria that are, differentiated or most relevant to retail investors or crowdfunding rather than VCs, it's mainly going to be around kind of objectives for the project, right? Like philosophically, are they here for the right reasons? Are they here to just raise a bunch of money regardless? Or are they legitimately trying to involve the community at the right terms, right? And I think you do see, again, smarter or more savvy projects realizing like, okay, rather than raise 1 million from one VC, we could raise, 10,000, maximum cap per person of 10,000 from 100 different people, right? And now those are these angels, and we can hand select them. Like one of Legion's most unique features is what we call Legion Score, where every investor who signs up to the platform has this reputation system. You can optionally connect your wallets, your GitHub, your socials. And so the teams can literally go one by one, if they wanted to, through these thousands of applications and hand select, this is the most value add investor for what we're building. And I think that is like what we look for in a project is, do you recognize that benefit? Are you truly trying to build a community and kind of, value looping in people? Or are you just as willing to take a $1 million check from one VC and kind of, sail off into the sunset?
And then on the user side, what does that journey look like on the platform? And does it look the same for a VC as it does for myself, that's just a regular retail investor?
Yeah, our goal is that it looks very similar. The experience should level the playing field. And so for both a VC and an average, retail user like myself, you would sign up, you would create an account. Onboarding is pretty quick. Just configure, if you your username, and you can skip kind of connecting any other external accounts right off the bat, and then you can see, depending on some jurisdictional for regulatory reasons constraints, you can kind of see deals that are live on the platform or coming up. Obviously, if you want to participate in a given sale, there is a step to first complete, KYC. That's just a must, a necessity of being in a regulated industry. But you would complete KYC, and then if there's a given sale live that you want to participate in, you can check out details. You can see the listing page, the full kind of investment memo. If you want to dig in really deep, if you want to stay more surface level, you can look at the tokenomics, the team, right? What their social tractions are, what's happening on social, on Twitter about them, etc. And then you can choose to invest or choose to apply. And at that point, you'd probably want to, if you haven't already, connect some wallets. You can do that privately. Connect your X account, connect your GitHub. Just showing, optionally sharing only with the project the type of on-chain user you are, the type of value you can add to them. You can add a cover letter. You apply for a sale, and then you get approved, and you get your tokens, deposited to that same smart contract that you deposited funds to participate in the sale, and then you claim those tokens again from the app. So relatively seamless process. All the funds, everything is handled on chain. There's no wires, there's no delays, there's no fiat. We find that is a very smooth experience, both for investors and for projects, and even for Web2 investors, because we can have like native in-app kind of widgets to onboard. We have a native in-app widget at the time of checking out to bridge. So no matter where your assets are, it's only like one extra click to participate in any deal.
Now, you recently secured a partnership with Kraken, and I hesitate about bringing up partnerships only because I feel like in Web3, whenever 9 times out of 10, it's usually
Yeah.
like a marketing gimmick,
Yeah.
a way to generate attention. But I'm curious to know, like, why the partnership and how do you guys work together?
Yeah, so I'm glad to say that it's not just the optics type of 2017 partnership. We've got 36 partnerships we've announced and don't do anything with them. Now we take kind of our moves very seriously, and so we have a limited number of partners, Kraken being one of them. And it ties into our ICO underwriter, strategy here, right? We're here to help projects maximize their distribution globally and find the best investors for them. And so Kraken's kind of the first centralized exchange we've announced as a partner. An Asia exchange will be announcing shortly as a partner as well. And so that lets projects really reach the whole globe. You can reach native on-chain users with a smart contract sale on Legion, right? You can reach our 300,000 native users. And then we also have a couple wallets and additional partners that are driving traffic to the Legion sale. So you're reaching actually millions of users. Plus, you have people participating off chain on Kraken. So if they're an existing Kraken user, they can participate in the sale without ever even needing to hear of Legion, let alone come and sign up to Legion. And similar with our partner in Asia. And so you get, from a project's point of view, on-chain distribution, off-chain distribution across all the global markets, across multiple exchanges. You get listings for secondary trading with that. So it really just becomes a very, very strong value proposition for the best quality projects that want to maximize their distribution and find the best investors. And it's very attractive when the alternative is, only working with one centralized exchange's launchpad, for instance, right? You get much more coverage, much more distribution working with Legion. And so we're happy that we've run 2 sales now with that partnership with Kraken, where people could participate either via Legion or via Kraken. Yield Basis and Football.Fun both sold out, both successful. Yield Basis had like $200 million deposited in 24 hours, and opened up at like a 5x and has sustained it. So yeah, off to a great start. And we're really excited about the partnerships we have in 2026 as well.
Amazing. Yeah. Looking forward to hearing more about that in the coming months because it seems like things are moving very rapidly for you.
Yes. Yeah. I mean, it's always moving rapidly in crypto, but yeah.
Anything else that's coming down the pike in terms of updates, milestones that you're trying to reach?
Well, we're always trying to think one step ahead. I think we're, as I've been talking about, network and protocol tokens will remain relevant, but I think tokenized equity and equity type products will be very important. So we're building those out, and as announced actually at Breakpoint, we will be supporting equity raises Q1 next year. And so I think that opens up kind of early stage investments as well, maybe some Web2 investments. So we got a lot we're working on where we think traditional finance is moving more on chain. And at the same time, ICOs and tokens are realizing they need to be a bit more like equity in most cases and is becoming more regulated. And so we see a future actually where IPOs and ICOs are the same, one and the same thing. And we're building for that future where we're the world's first on-chain underwriter. Right now, ICOs, but in the future, these things we haven't yet figured out a name for, or that, not just Legion, I mean, but everyone hasn't yet figured out a name for these hybrid ICOs slash IPOs.
We truly are seeing a convergence of two different worlds. And on that note, because you mentioned Breakpoint, which is a Solana focused conference, are you guys solely focused on Solana, or is this also EVM compatible? Does it matter what ecosystem the projects are building on?
Yeah, largely doesn't matter. We're relatively agnostic. We like to support each ecosystem for its relative strengths. I think Solana is doing a lot of great things, especially around tokenization these days and institutional use cases. We have, as I mentioned, like the sales themselves are run fully on chain by smart contracts. And we have audited smart contracts and have run sales in both EVM and SVM, bunch of L2s, Ethereum L1 itself. Pretty easy from a project point of view to support them wherever they are.
And where can people follow along? Any links that you could share with the audience?
Of course, yeah. So our website is going to be legion.cc, and then our X handle is going to be that just spelled out. So legion.cc, legion.cc. And then for myself personally, you can find me at Matty _ as my X handle. So MATTY_.
Perfect. I'll be sure to include those links in the description. Maddie, this was a real pleasure. I really enjoyed this topic. I know it's not an easy one to cover, but I could definitely see your enthusiasm and passion. And clearly, I see you've been spending a lot of time and effort in this area. So appreciate you joining me today. And for those that are watching, please like the video, subscribe to the channel, give Maddie a follow, and we'll catch you on the next one. Thanks, Maddie.
Thank you.